CFA Level 1 Practice Questions. Learning Module. Analyzing Statements of Cash Flows 2. Topic: Evaluating Sources and Uses of Cash. According to the CFA curriculum, what is the recommended first step when an analyst begins an evaluation of a company's statement of cash flows? A. Compare the company's operating cash flow to its net income to assess earnings quality. B. Calculate key cash flow ratios, such as cash flow to revenue and cash return on assets. C. Perform an overall assessment of the major sources and uses of cash between operating, investing, and financing activities. A company reports that its net income increased from $45 million to $48 million, while its cash flow from operations decreased from $62 million to $28 million. This divergence between net income and operating cash flow most likely suggests the company experienced a significant A. Increase in accounts payable, B. Decrease in inventory levels, C. Increase in accounts receivable. The CFA curriculum recommends starting cash flow analysis with a broad overview of the cash flow statement to understand cash flow dynamics. A. Incorrect. Comparing operating cash flow to net income is important for evaluating earnings quality, but it should not be the first step. Understanding the cash flow structure is crucial before making this comparison. B. Incorrect. Ratio analysis is valuable for assessing efficiency, solvency, and liquidity, but should follow an understanding of cash flow composition to avoid misleading results. Increase in accounts receivable boosts net income, but reduces operating cash flow, raising concerns about earnings quality. A. Incorrect. Increase in accounts payable unlikely explanation for decrease in operating cash flow. B. Incorrect. Decrease in inventory levels unlikely explanation for observed decrease in operating cash flow. Topic: Ratios and common size analysis. An analyst is preparing a common size cash flow statement to compare the cash flow trends of two companies in the same industry. Which of the following methods is most appropriate for this analysis? A. Express each cash inflow and outflow as a percentage of total assets. B. Express each line item on the cash flow statement as a percentage of net revenue. C. Express each line item of cash outflow as a percentage of total cash inflows. An analyst is reviewing a common size cash flow statement, prepared using the total inflows-outflows approach. The data shows that cash received from customers represented 92% of total cash inflows in the current year, down from 98% the previous year. Over the same period, proceeds from long-term debt increased from 2% to 8% of total cash inflows. The most appropriate interpretation of this trend is that the company A. Improved its operating efficiency, B. Increased its reliance on financing activities for cash, C. Decreased its overall investment in property, plant, and equipment. The net revenue approach expresses cash flow statement line items as percentages of net revenue, normalizing statements to sales levels for direct comparison of cash generation, management, and investment capabilities. This method facilitates trend analysis and comparisons between companies, especially within the same industry. A. Incorrect. Total assets are not the standard base for a common size cash flow statement, as it doesn't directly reflect cash flow trends related to operations. C. Incorrect. The method focuses on outflows and inflows but doesn't account for operational scale or revenue generation. Operating cash inflows decreased from 98% to 92%, while financing inflows increased from 2% to 8%, indicating a shift towards external financing. A. Incorrect. Decreased cash received from customers may indicate declining operating efficiency, not improvement. C. Incorrect. Cash inflows from customers and long-term debt are known, but investment in property, plant, and equipment is unknown. Topic: Free cash flow measures. An analyst is calculating free cash flow to the firm, FCFF, for a company that reports under IFRS. The company includes interest paid as a cash outflow in its financing activities. When starting with cash flow from operating activities, CFO, the most appropriate calculation for FCFF is a CFO plus interest times 1 minus tax rate minus fixed capital investment. B CFO minus fixed capital investment. C CFO minus interest times 1 minus tax rate minus fixed capital investment. A company reports the following financial data. Net income $1,800 million. Depreciation and amortization $350 million. Interest expense $250 million. Capital expenditures $450 million. Investment and working capital $50 million. Tax rate 30%. The free cash flow to the firm, FCFF, is closest to A. $1,825 million. B. $1,975 million. C. $2,025 million. A company reports the following financial data. Net income $280 million. Depreciation and amortization $45 million. Interest expense $35 million. Capital expenditures $90 million. Increase in working capital $15 million. Tax rate 30%. The free cash flow to the firm, FCFF, is closest to E. $244.5 million. B. $274.5 million. E. $195.5 million. Under IFRS, CFO already reflects cash flow before interest payments, so no adjustment for after-tax interest is needed. The only adjustment required is subtracting fixed capital investment, FCINV, to account for reinvestment in the business. A. Incorrect. Formula is correct if interest is deducted from CFO. Adding back after-tax interest would overstate FCFF. C. Incorrect. FCFF should include the tax benefit of debt, not exclude it, to accurately reflect cash available to all capital providers. FCFF is calculated by adding back non-cash charges and after-tax interest expense to net income, then subtracting capital expenditures and working capital investment. The FCFF is approximately $1,825 million. FCFF is calculated by adjusting net income for non-cash charges, interest expense, and capital investments. Topic: Cash flow statement analysis. Cash flow ratios. An analyst calculates a cash flow-based ratio for a company with the following components. The numerator is the sum of cash flow from operations, cash paid for interest, and cash paid for taxes. The denominator is cash paid for interest. This ratio is best characterized as a performance ratio measuring operating cash generated per dollar of asset investment. B. Coverage ratio measuring the company's ability to meet its interest obligations. C. Solvency ratio measuring the company's ability to acquire assets with operating cash flows. An analyst observes the following trends in a company's cash flow coverage ratios. Reinvestment ratio decreases from 2.5 to 2.1. Dividend payment ratio decreases from 4.0 to 3.2. Investing and financing ratio increases from 0.9 to 1.3. Based solely on these trends, what is the most appropriate conclusion about the company's ability to use operating cash flows? A. The company's ability to pay dividends improved. B, the company's ability to acquire assets with operating cash flows deteriorated. C, the company's overall capacity to cover investing and financing activities improved. A company reports cash flow from operating activities of $4,850,000 and operating income of $6,200,000. The company's cash to income ratio is closest to A 0.78, B 0.65, C 1.28. The ratio, which adds back cash, interest, and taxes to CFO, measures how many times operating cash can cover interest payments. A, incorrect. Performance ratios assess efficiency or profitability, but the given ratio doesn't compare cash flow to asset investment. C, incorrect. Solvency ratios assess long-term financial flexibility, not reinvestment ratios. The investing and financing ratio increased from 0.9 to 1.3, indicating a fundamental improvement in the company's ability to fund external cash demands from operations. A, incorrect. Dividend payment ratio decreased, indicating a deterioration in the ability to pay dividends from operating cash flow. B, incorrect. Reinvestment ratio decreased from 2.5 to 2.1, indicating a deterioration in covering asset acquisitions with operating cash flow period. However, this conclusion is narrow and doesn't consider the overall investing and financing ratio improvement. Cash to income ratio is 0.78, indicating 78 cents of operating cash flow per dollar of operating income. A ratio near 1.0 or above indicates high quality earnings and good cash conversion. A ratio below 1.0 suggests operating cash flow is less than operating income, potentially due to working capital investments, non-cash income, or timing differences.